Actually, especially when it comes to doctors, it's a political discussion, right? So this is a jurisdictional issue that has come to haunt Canadians for quite some time.
It's completely foolish to rely on, a tax rule or a tax rate that has been in effect, even if for 24 years.
Hi, and welcome to The Missing Middle. I'm Cara Stern.
And I'm Mike Moffatt.
And today we're joined by Bhuvana Rai, a tax lawyer with Morris Tribute, and Birute Luksenaite, an estate lawyer with Portfolio Estate Law.
But before we get started, don't forget to like, subscribe, and leave a comment. We'd love to hear from you.
Welcome, you two. Thanks so much for joining us. Can you tell us a little bit about yourself and your practice? Let's start with you, Bhuvana.
Sure. So I'm Bhuvana. I'm a tax lawyer in Toronto. And 2 years ago, I founded Morris Tribute Tax Law, which is a boutique tax law firm in downtown. Our focus is mainly individuals and small businesses.
And what about you, Birute?
So I have a small tax and estate law practice, which means that clients come to me when they want to plan their estates, optimizing them from the tax perspective, as well as when someone passes away and the estate requires administration. And I'm in the West End, and my clients are sometimes my neighbors, small business owners, immigrants, ordinary pensioners.
On April 16th, the feds tabled the budget, and one of the key proposals that we saw was an increase in the capital gains inclusion rate from 1/2 to 2/3 for corporations and trusts for individuals on the portion of the capital gain exceeding $250,000, which is an absolute mouthful. So, Bhuvana, could you work us through that? Like what's getting taxed here? What exactly is a capital gains, and what is the effect of this change?
Yeah, so capital gain can be distinguished from other types of income. And this is controversial, right? So we have, during the history of taxation in Canada and in other countries, there's a lot of tension about how we tax different things, whether we tax all types of income the same, whether we tax different types of income differently. And one of the key differences between the way that we tax income is how we treat something like a capital gain as opposed to something that's ordinary income. So what's ordinary income? We think about things like employment income, business income, things that are predictable, things that are annual, things that are regular, that you expend a lot of effort yourself to gain money through, and those are considered to be ordinary income. You pay tax on that yearly. You are expected to have some certainty and predictability around how you get that money and what you're supposed to remit from it. A capital gain is fundamentally different from these types of things because it is the difference in the value of a capital asset between the time that you've purchased it and the time that you sold it. So if you bought something for $1 and then it is worth $10 10 years later, then you've had a gain of 10 minus $1 equals $9 over that period of time that you've held it. And you'll pay a capital gains tax only when you have a disposition of the asset. So you don't pay tax yearly on your asset as it increases in price, but you have a lumpy gain on the year that you decide to sell it or gift it or have another sort of disposition event. The capital gains tax is the tax that you have on that difference between the price at which you bought a capital asset and the price at which you sold the capital asset.
And the inclusion rate then means that's how much of it you're getting taxed on, right? You don't get taxed on 100%, you get taxed on 50% or now 2/3 of what the gain would be?
Yeah, there's a lot of rates to talk about. So I just, when it comes to an inclusion rate, it's not the same as a tax rate. The inclusion rate is the amount of the capital gain that would be taxed as though you earned it like regular income. So going back to the example of that $9 capital gain that you've gained over 10 years or so. If you have a capital gains inclusion rate of 50%, then only $4.50 is included as regular income to you as though you earned it that year. So that's the halfway house that we've had during history, is that we have an inclusion rate for your capital gains where we essentially pretend that you earned it like normal income during that year, and then the rest of the gain is tax-free.
Why do we tax it at less than the rate that we tax income? Because it seems like income is something that we want. Like we want people to be productive and earn money rather than earning through capital gains. I guess the country wants both, but it kind of feels like they're incentivizing capital gains rather than working. Is that right, Birute?
Well, I guess there's controversy in that regard, but it is generally considered that capital is sort of a passive source of income where it's not really dependent on labor or someone doing working really hard to make a return on it. However, there are arguments that returns to capital are actually a combination of the owner's inputs, the owner's situation in life, the owner's contacts and networks. But because it is considered passive with potentially more risk involved as well, because a capital asset can both appreciate and depreciate, that could be viewed as some of the incentives for taxing capital at this lower rate. But also because capital is generally viewed as being a long-term asset. So you have to have patience and wait a long time to earn returns on it.
Mike, does it make sense to you that that's how it goes?
So I'm going to give a really annoying two-handed economist answer to this because I kind of see both sides of this. That, one of the reasons why you want to have a lower inclusion rate is that some of these assets are already been taxed anyway, right? Like, so let's talk about stocks, right? Let's say somebody goes out and buys, one share of Missing Middle Corp. That company is already making money, and paying corporate income tax on that. So they're already getting taxed that way. And then when that stock goes up in value and then that person, the owner of the share sells that, well, now they're paying, a second essentially sort of income tax on it. So I could see why you'd want to do that at a lower rate to avoid double taxation and this whole idea of a buck is a buck is a buck. And, you don't want to, you don't want to preference one form of taxation or another, or, have higher tax rates for some activities than others. But that actually segues into my kind of counter argument is that, in many ways, some of these assets are paying lower taxes and some of these forms of income are paying lower taxes. And you can have a situation where you have somebody who is buying up and flipping investment properties, essentially paying a lower income tax than a nurse or a teacher, which just doesn't seem right to me. So, I see both sides of this, and it feels like the media sees both sides of this because I read op-eds. Some are saying that this change is going to break Canada. Others say it's a nothing burger. And then a third group of folks say like, oh, this is going to, help fix Canada's inequality problem. So Bhuvana, can you walk us through this? Like, there's so many competing opinions here. Like what is your take?
Yeah, I mean, look, I'm just going to add fuel to your fire here of reasons to think that it could go either way by talking to you about the historical context and also about alternative minimum tax. So look, 67%, which is the proposed new inclusion rate, is not the highest that capital gains inclusion rates have been through our history. We've had rates as high as 75% in our history I think this was in 1990, before it was brought back down to 67% in maybe the early 2000s and then back down to 50%, which is where it's been for about 24 years now. So we've seen this before, right? And capital gains tax is instituted at all in our history, exactly like Mike said, because of the proposition that a dollar is a dollar is a dollar, which came from a famous report that was commissioned called the Carter Report. It made a lot of people really furious because it said that, we should tax all income and all dollars in to someone in the exact same way and tax them at the exact same rate. Lots of business people pretty mad about this. Lots of people thought it might reduce investment in business. And so in 1972, it was sort of a surprise to people that we did have a capital gains tax for the first time and that it was set at 1/2 as an inclusion rate, which was the default and also the rate before this change takes effect in June. So look, I guess really what I'm trying to say there is we've done this before. We've had a high capital gains rate before, and it hasn't bankrupted us yet. That said, I mean, the modern day economy is a little bit different, right? Because we actually have alternative minimum tax now, and that hasn't been a big consideration before. Alternative minimum tax sets a baseline for how much tax we expect everyone to pay as an effective tax rate, regardless of any credits, deductions, etc.
Sorry, what does that mean, the minimum that you're talking about?
Yeah, so it's just a minimum effective rate on a certain amount of income. So the idea is, you don't get to claim deductions, credits, etc., beyond a certain minimum amount that's set fairly low. But the idea is specifically to target, I guess, the mischief that Mike is pointing out, which is that you don't want to have people that are making a lot of money that are just claiming offsetting deductions. We've made that decision from a policy perspective that we want people to have a minimum effective tax rate. And so the alternative minimum tax comes into effect to change that landscape a little when it didn't really exist in the same way during those other times that capital gains had such a high inclusion rate. On the other side, something else to think about, though, is capital gains are lumpy by their very nature, right? And maybe that's really the issue that we need to think about from a tax perspective is the timing of capital gains. So remember that we have a progressive system of taxation. If you make more than $250 a year or so, then you're going to be taxed at a really high federal rate at above 50% in most provinces. If you are someone who is a pensioner making fairly low amounts of money, and then you sell your family's vacation home, right? This is sort of the classic argument. And we can talk, Mike. I know you care a lot about housing policy. We can talk about whether you're really middle income if you have a vacation home. But at the same time, if you have one lumpy sale, no matter how long you've had the property or how poor a return it would really be thinking about it for the, say, 30 years that you've had that property, one lumpy year can push you into the highest tax bracket if we tax a dollar as a dollar. And people will question whether that's fair and whether that's appropriate. So, the gain that you could have had, a 10% tax rate on for the last 30 years each year and just paid almost no tax on will now be taxed at 50+%. That doesn't seem fair to people.
What do you think, Birute?
Oh, I agree with Bhuvana. I already have a number of clients who've come to me in a panic wanting to know what to do. A typical client will be someone who has a few properties that they will have saved up for and purchased for the purpose of bequeathing to their children. So as an example, recently a man came to me wanting a good tax strategy to bequeath his 3 properties to his 3 children. One of the properties will benefit from the principal residence tax gains exemption, but the other 2 properties will not. And he has just barely enough cash to pay the tax at the 50% inclusion rate on the capital gains that will arise on those 2 properties. So a few months ago, he had enough cash to pay that expectant tax, but now he will no longer have that. Other clients have taken out life insurance precisely for that amount of tax. Or their children are planning to take out mortgages when it comes time to acquire these properties from the estate for the purpose of assisting their parents' estates with the capital gains tax. And everybody relied on the 50% inclusion. Now, I agree, it's completely foolish to rely on, a tax rule or a tax rate that has been in effect, even if for 24 years. But people's expectations obviously anchor on a good thing, and nobody wants to part with a good thing.
Mike, how much sympathy do you have for people in that situation?
Well, I think Birute makes a really good point about the sort of planning on this, that this June 25th deadline does seem unreasonable to me. That, the taxes change, and, I don't think you should ever put too much faith in any government not to change the rules. But I think that makes sense that, when you're sort of planning and you're sort of setting aside, okay, well, this is how much I need to set aside for taxes, and this is how I need to structure a life insurance policy, and so on. And then the government says, okay, you have to change that within 90 days. I do have some sympathy there. I don't think that's a great way of going about it. But on the other hand, it is. We are looking at people who own multiple properties, and we have a lot of people in this country who don't own any. So I think that's the sort of challenge here. But I would agree that this planning issue is important. So besides the sort of date, that June 25th date, and I'll open it up to either one of you. Would you, how else would you like to see this have changed? Because we very well may see the federal government tweak this in some way. Are there any changes that you would like to see to this?
If we're targeting the so-called, super earners, the super, the top 1%, for the majority of people who realize capital gains, these will not be capital gains earned on assets that were intended to generate a tangible profit. These were assets that were intended to provide, family shelter, even if it's a family cottage, or, a second home for a second child. Or, for example, doctors and other professionals who have an incorporated practice who don't benefit from the same benefits that employees do. But the 1% that I think we do want to target, those are the big ticket investors. And if they have to realize capital gains, they will make their capital gains fit within the $250,000 a year, whereas ordinary Canadians who are disposing of, say, a cottage, or they're dying and they're bequeathing their cottage to their children, they will have that one big taxable event that will all be included in that one taxation year. So I think they won't have an opportunity to, structure their gains in a way that does benefit from the lower, bracket of the $250,000. So I think that the threshold at which the higher inclusion rate kicks in, if we're properly targeting that, demographic that is considered the top echelon of our society, I think that threshold should be higher. It should not be $250,000.
Bhuvana, do you want to respond to that?
Yeah, I mean, look, Mike's original question was thinking about the changes that we'd want to see to the legislation, whether the government might tweak it and so on. I think my biggest concern is that we haven't seen the legislation. And given that it is supposed to come into effect in 1 month, that scares me. Because I think one of the ways that we ensure we have good policy and good legislation that doesn't have unintended effects is by ensuring that we get to see it ahead of time, is by ensuring that people get to provide feedback on it. And it worries me that we have not had an opportunity for tax practitioners and accountants and lawyers to review that legislation before it's purported going into force date. That really worries me, because that's how we catch mistakes, unintentional consequences, misdrafting, all of those things. It's a really big job for the Department of Finance to have to do. And so I think that just worries me. But assuming that, the change is only that 2/3 rate, as well as the corresponding increase in the lifetime capital gains exemption, and a proposed new entrepreneurship credit about which we have no details.
What do you mean?
So there's this new entrepreneurship credit that should be phased in over the next 10 years, starting next year, if the government, and that's in the budget. That's part of the package of changes that is included with this capital gains exemption. The lifetime capital gains exemption is another thing that I mentioned. So we already have a lifetime capital gains exemption for businesses in the position that Birute just spoke about, where a business owner might be able to dispose of their shares to a third-party purchaser and make use of something called the lifetime capital gains exemption. They're bumping it up by $250,000 from $1 million to $1.25 million as a one-time thing to make up for the capital gains inclusion rate increase, so that the capital gains increase will not have too much of an impact. I think, like I said, haven't seen draft legislation, really hard to predict. I think that's what they're trying to do. There's a new entrepreneurship credit that's also been proposed, which sounds like it has a lot of promise, where they say we're trying to encourage Canadians to build businesses, small businesses, and be entrepreneurs. And so they say you'll get almost like this corresponding capital gains exemption type thing, where you might get $200,000 a year that is eligible for 1/2 of your 2/3 inclusion. So you'll get actually taxed on 1/3 of your capital gain as though it were income. And we'll, do that to 200,000 of gains per year between next year and 10 years from then. So the ultimate impact would be to have a $2 million exemption on top of the lifetime capital gains exemption for certain types of entrepreneurs.
Mike, do you think that part of the purpose of this is to kind of target people who have been holding on to multiple properties? Like if they're hoping to give it to their kids, fine. But I know that that's something that, we've talked about how there's a bit of a problem where you have basically need to have family with wealth in order to afford a home these days. Is that what the government's trying to get rid of by giving them this new tax rate?
It's hard to tell the purpose of this. I think it serves multiple purposes. Like the obvious one is it raises $4 billion a year. You can argue whether or not that's necessary. We have deficits of a certain level, and I think a deficit plus $4 billion, is not going to change things one way or another. So that's part of it. I'm sure part of it is political. But yeah, I do wonder if part of the goal here is to have people sell these properties in advance of the tax, and get them into the hands of first-time home buyers. If that is what they're trying to accomplish, then I think that's even further indication that this June 25th deadline needs to be pushed out, because it doesn't give people enough time to get their houses staged and on the market and that kind of thing, let alone enough time for first-time home buyers to go out and qualify for a mortgage. So, yeah, it's challenging. I think they're trying to accomplish a lot of different things at once, and it's tough to see. It's tough to really understand like what the purpose of this is.
It was 25 years ago that the inclusion rate was dropped from 75% to 50%. Did we see a bunch of new investment from that tax cut? Bhuvana, can you tell us a bit about that?
I'm not sure that we did, partly because it was a bundle of changes, and it's really hard to tell what is the specific result of one type of change. I think as I talk about the entrepreneurship credit and the increase in the LCGE, the lifetime capital gains exemption, you can sort of see that the government almost tries to sweeten the deal anytime they do something like this, partly because there are people that have planned for a certain amount or a certain level of taxation that that are now subject to completely different rules sort of overnight. One of the things too that I would highlight there is when Birute talks about people that are expecting to pay a certain amount of tax, it isn't just the question of, they're wealthy and they have this property that, they're going to keep, but also that it's a question of liquid cash. If you have to pay a capital gain, then you actually can't keep your asset anymore, right? Because if you're being taxed at a 50% rate on 50% of your asset, then you actually have to liquidate 25% of the asset. And if that asset is a small family business, you're going to have to sell your business. And that's really bad, right? In a lot of ways, because turnover isn't always good for employees. You want to encourage people to be invested in their business, feel invested in their business, keep it in Canada. So that's actually part of why we do this. I mean, there are some real issues when it comes to liquidity, because you can't pay the government in shares of your corporation. That's not a currency we accept. Maybe it's something that they should look at, but it's not a currency that the government accepts.
Don't you only have to pay the gain when you sell, in which case you have the cash?
No, you have to pay the gain when you have a disposition event, which is not always when you sell. And by the way, when you sell a business, very few people are going to give you cash. Most people are going to give you a portion in, cash, a portion in future options, in stocks. This is the currency of entrepreneurship. So you're getting taxed now on money that is by definition not liquid. Right? So that's the struggle for smaller and family businesses that I think, without being in the industry, I wouldn't really be aware of. And that's why Birute mentions life insurance, because that's actually usually the way to pay for, a family business on death, which is a disposition event. We don't have a tax on your estate, but we do expect you to file as though you had sold that business at the time of your death. And that's good. That's fair, because in the US, you can actually have something that your parents or your grandparents bought for a pittance, like decades ago, that continues to pretend to be at the same cost base until you sell it to a third party. That's probably not a good thing either when it comes to quality. But here, because we expect you to report that tax at the disposition event, that means you might not have the liquid cash, and your family might not have the liquid cash to actually be able to keep the asset that might be both sentimental and money-making. What we want to do with that as a policy decision is something that we decide on as a country and that we vote on. But I'm trying to explain to you the real challenges that I think people would feel when they are faced with that kind of situation, and the resentment that they feel.
Mike, do you think that part of the problem is that, like, we're talking about so many different situations where there's different kinds of people affected by this, and kind of the public will have different levels of sympathy. Like, obviously, they're going to feel more bad when you hear about doctors not being able to practice as much. We can get to that, but that's been a big conversation about how this will impact doctors. You might have some sympathy for that entrepreneur. You might have less sympathy for someone who owns a ton of investment properties and is just upset they're going to have to pay more. Like, is this just too blunt of an instrument to deal with all these situations?
Well, I almost wonder if it's too blunt of a political instrument. This affects different people very, very differently because of entrepreneurship, because of rules around farms, right? So this affects farmers different than it does other businesses versus doctors and things like that. And Birute, I was wondering if you could walk us through, like, reading the opinion pages, I see doctors particularly upset by this. And I don't think the general public understands why. Like, why does this affect doctors more than, say, engineers or university professors or other, relatively high income folks?
So, yes. Certain professionals are permitted to incorporate their professional services businesses, which allows them to have their active business income or professional services income to be taxed at a lower rate than if such income was received directly by such professional receiving that income directly. So if that income is received in the corporation, it is taxed at a lower, very low rate, less than 15%, depending on which province you may reside in. And the professional only draws such amounts of income that they require in the year for living on. The remainder they can leave in their company, allow the savings to grow, perhaps through investments at the small business corporation tax rates. So now, the inclusion rate for corporations up until now was 50%, just like for the rest of us, individuals and trusts. If that rate is increased to the 67% that has been proposed, which rate will apply to all capital gains of corporations, there will not be a preferential rate for the first $250,000 of capital gains. So there will be two things. So the corporation will pay a higher rate of tax on its capital gains type income, and there will be less after-tax money that the owner will be able to withdraw. Now, small business corporations pay actually a higher rate of tax on top of the inclusion rate on investment type income rather than large corporations. So, I actually think that big corporations who benefit the most from wealth that is socially generated, wealth that is created by giving no choice to the population but to use them, such as banks or utilities or telecommunications companies or grocery stores. If you want to work in Canada, you have to have a bank account. If you want to have a bank account, you have to pay bank fees. You have to surrender your money to the bank in order to have that service. And banks make tremendous profits on just simply people needing to live and get by, as do telecommunications. So I think all of that needs to be taken into consideration when we're implementing these, new tax programs. So for doctors who see this direct impact on them when they don't see that direct impact perhaps on other corporations, like large corporations, it is definitely a disappointment.
Bhuvana, how much of this conversation is a political discussion versus an economic discussion?
Actually, especially when it comes to doctors, it's a political discussion, right? So this is a jurisdictional issue that has come to haunt Canadians for quite some time, which is that some years ago, the provinces and the medical associations across the country came into negotiation about doctor wages, which are low, right, in Canada. And instead of, and I'm saying that specifically compared to the US. And so instead of giving doctors more money, which I think is actually easier to track and also would have to be paid by the provinces, which are in charge of incorporation, decided that they would allow doctors to become the only professional that can income split through corporations. So a doctor can form a professional corporation and they can actually use that to income split, because a doctor's corporation can have shareholders that are not doctors in it. That is not true for any other regulated professional. So accountants can't do that. Lawyers can't do that. So don't worry, no income splitting here. No other professional is permitted to have a personal service business that just includes their spouse or family as a shareholder. So the doctors' associations, the various medical associations, accepted this trade because it's actually a huge benefit from a tax perspective to be able to tax all of your income at lower marginal rates, right? So instead of having one person earning, $400,000 a year, a lot of which would be taxed at the highest marginal rate, you have 2 or even 3 people if you have children, or 4 people each earning $100,000 at much lower rates, and you get to multiply your personal exemption. Doctors like this. They got attached to the idea of not having to pay as much tax on the money they earned. And I think, there's not a lot of tax literacy in terms of the fact that no other professional can do this, right? And that it was an explicit trade-in for the provinces not having to pay doctors more. Provinces liked this because mostly they're actually redirecting federal funds, right? So they're actually giving back federal tax money to doctors without having to pay for it themselves, because provincial tax rates are much lower than federal ones. So because of this jurisdictional issue, we have this holdover where doctors essentially are the only professional that's allowed to income split. Ever since that change, doctors or medical associations have opposed any measure that would increase tax on small corporations because it hurts their members disproportionately, because their members disproportionately benefit from the small business tax rates more than anyone else.
It makes me think about how many conversations we have where it's like the federal government and the provincial government, they're separate but overlapping responsibilities, and how that's such a challenge in Canada. So I guess this is just like another one of them where it's like, how come they can't work together properly or plan their policies together? We hear it all the time. We're going to keep hearing it again, I'm sure. Thank you guys so much. We really appreciate your time, that you're able to come and join us and help us understand this better.
Yeah, thanks so much. I really feel like I understand this better now, not just from an economist point of view, but from a legal point of view, which is often what us academics are missing. So thank you so much for this.
Thanks so much for watching and listening. And thanks as always to our producer, Meredith Martin.
And if you have any burning economic, tax, or housing questions, please feel free to reach out to us at missingmiddlepodcast@gmail.com.
And we'll see you next time.